Welcome to Relay Chain, a podcast produced by Parity Technologies where we discuss all things substrates, Polkadot, and Web3. Today on Relay Chain, we have Ruitao and Antonia from Laminar Protocols and Acala Network, and this will be our first remote recording of Relay Chain. So welcome to both of you. Do you want to do a quick introduction of yourselves? Ruitao, you can go first.
So my name is Ruitao. Thanks for getting us on the Relay Chain podcast. We are a team of builders on the substrate ecosystem. We've been building on substrate for a very long time. One of the few first adopter on the substrate network. We've been building two very interesting protocol, a stablecoin protocol that's called Acala Network, and also a synthetic asset trading protocol, which we call it Laminar. We have a distributed team, and we pretty much most of the team is based in New Zealand.
And Antonia?
Hi there. So my name is Antonia. First of all, I am the so-called chief economics in both Acala and Laminar projects. So I'm not only majored, in economic research and mathematical research. Also, I've always been interested in technology. So I've been involved in technology startups and a variety of blockchain projects, including token economic designs.
Okay, great. So we're going to kind of go over like DeFi and Laminar and Acala separately. So to start from like a very high level, like how do you define DeFi and how does it compare to like more mature financial markets?
So I think DeFi is pretty much like a set of finance-related smart contract running top of blockchain. Like either it's called smart contract or a specified chain that's running on top of blockchain in distributed ledger. So there's some very unique aspect of DeFi. We can call that trustless being number one unique aspect of DeFi. That means you don't need to ask anyone's permission to enter or play with the financial system built on top of blockchain. That's like transparent, that you can pretty much be sure that the rule is set and everything that you play, that you are trying to interact, will be governed by the set the rule that you agree to. So I think that's very unique. And regardless of all these unique aspect features, I think it's still pretty much the same with traditional finance. So whatever that's available on traditional finance right now, they could be available on the blockchain and they could become DeFi at some stage.
Yeah, so like that kind of leads to another question that like there's not just the transparency aspect, but also the complexity. And so we've seen a lot of problems in the traditional financial system with like exploitation and part of that is due to the opaqueness of it and kind of how it's closed off. But also, like, trading is by nature a zero-sum game. Like, anytime somebody wins, somebody else loses. And so even if these protocols are transparent, they could still be incredibly complex. So, like, how does DeFi end up being better or, like, more fair than, say, the traditional financial system?
Well, I think that we have some sort of faith on the traditional finance system. Like before we talk about DeFi, what we currently have on the traditional finance system, people talk about that, hey, it cannot fail, or it's because it's been working like that, and people get used to the idea of the traditional finance, like everything's opaque and in a black box. People assume that it's going to continue to behave and work. But I don't think that's the case. A number of times that we see the traditional finance failed, like the subprime mortgage crisis that we have, that's completely one of the failure of the traditional finance. That's maybe that we can compare that to what would happen on the DeFi space. But my point of view is that on traditional finance, simply because it works and it works to a certain degree that people get used to, it doesn't mean that it's going to work forever. It doesn't mean that it's the best solution out there. And DeFi, on the other way, while ensuring that everyone is transparent, everyone is bound by the rule that's set by the protocol, still there's some other factor of risky. There's some other risky factor out there, such as like there might be programming bug. We are still in very immature, in the early stage of DeFi, and those sort of problem is ought to be happen. But I think those problems can be solved. Like if on DeFi protocol there's bug and if there's performance issue, those through time can be improved and can be solved. And I think the key point is that if you look at the traditional finance and DeFi right now, there's not much room for improvement on the traditional finance side. You just can't tell the traditional finance institute to open up and be transparent. Those is just can't. And there's no way you can enforce a rule to say that you got to play by that rule. But on the DeFi, although it's currently complicated, it is there's a lot of risk in terms of like the program bug or things like that. The room for improvement is huge, and it also does not discriminate. There's a lot of stuff that we can see the glimpse of light if we think about that, and this is the future of the finance.
Yeah, so like besides just replicating traditional finance into DeFi, and like I think I'm going to cover the decentralized sovereign wealth fund stuff at the end, but like besides that, what kind of room do you see for completely new things? So like not just replicating what exists now, but like what kind of new things become possible with blockchain?
Well, I think there's quite a number of those, and we are still like on the tip of the iceberg. There's a lot of, I believe there's a lot of exciting stuff that developers or programmers, they're gonna invent or they're gonna find out once this space getting more mature. But for now, there's one example that I would like to see that's very, very interesting. That's already happening right now on the DeFi space is that your money can be in both places, and your money could be in multiple places. So think about what currently there's like DAI, there's CDAI, which is generated by the Compound protocol, right? And if you have DAI in the Compound protocol, you get a receipt of your DAI, and that's CDAI. And that CDAI is as good as the DAI that you put in, but it's like the interest-bearing part of your deposit. And those is as good as money, and it could be in other places. And to use the example, in the synthetic asset trading protocol they were currently implementing, on the Ethereum part they were currently implementing, we are actually accepting CDAI as sort of a currency for you to trade. That means while you are trading, your money is still in the bank earning interest. And that's something very, very new if you compare that to like the traditional offering from those traditional conventional financial institutes, because it's like running, like each company have different set of rules. There's not like one ledger, one trustless ledger to connect all these institutes. This sort of possibility is very, very hard on the traditional finance side, but we can already see those is like possible and very viable on the DeFi side. And this is just one of the example that I think is very fascinating, that your money could be in multiple places and doing multiple things at the same time.
Yeah, Antonia, like as an economist, maybe you have an opinion on this too?
Yeah, sure. First of all, I'm also very fascinated about how money is defined differently in the blockchain world. For say, in our Laminar protocol, you see people can do forex tradings, like through margin or through synthetic asset tradings. For example, like what you commonly say Euro USD. Okay. In the traditional world, if you want to do such trading, you have to go to a broker and make your deposit of your fiat money. And once you deposit this money through, for say, bank transfer to that broker or bank, you can't do anything with your money. You don't earn interest. That money is like, can be only secured for the margin trading. But if you do it through Laminar, regardless it's through Ethereum or Polkadot in the future, your money, as Ray said, can still be used, like earning interest through a lending platform, rather than, only be used and bonded to the trading itself. So it's something absolutely new to the whole finance world. Your money is not only a tool for trading, it actually comes with certain sort of investment value.
Yeah, I think to echo that, there's also another cases that might be very interesting is that on the Acala protocol that we are developing, there's also this stake liquidity protocol to enable you to have like stake dots and free the liquidity of your stake dots and able to get like some of the liquid dots that we call that. And like your money could be in both places, and also your money would also become voting power. Like because we designed the protocol the way that we think this protocol should be governed and operated by the dot holder that actually stakes through this protocol. So we also write the governance process as like to the more L dot that you hold, the more say you have on this network. So this is like the other way of like your money could be in multiple places doing multiple things. And those is like on the conventional world, on the kind of conventional finance world, those is the stuff that we dream about every day, but it's very hard to achieve.
Yeah, I think like, we should talk about that more like when we get into like Laminar and parachains and stuff. It's not just money, but you're taking it one step further into the other things that you can do with it. So like in that direction, like like both on Laminar, but just in DeFi ecosystem in general, like what kind of limitations do you see it facing right now?
First, I think the first challenge will be definitely performance. I mean, that is especially true if you are building a DeFi protocol. I think we all realize what happened in the Black Friday when Ether price crashed and make it out become insolvent. I think the fundamental problem of that is that, hey, the underlying ledger, Ethereum itself, is limited to X amount of transactions per second. And I actually wrote a blog post to say that, hey, the performance of the underlying ledger actually limits how much risk that the DeFi application can take that building on top of that. And this is like one of the challenges that we're facing right now is actually the performance of the ledger. That translates into the application that we are working on. Like the faster the underlying ledger is able to consensus to a set of data, the better price fit it would be, the better trading experience would be. And that ultimately end up to be like a better off for everyone. So that's the first challenge that we are facing is the performance of the underlying ledger. If you think about Ethereum today, it has a very, very limited throughput, yet it is enough to support a very, very large scale of DeFi or derivative finance on top of that. But that's just on the beginning, just like the tip of the iceberg. Think about that. If you are able to solve this underlying performance issue, all sort of other variety of product could become possible. That's the first challenge. And the other challenge that we're facing today is definitely like the usability issue. I think that pretty much everyone that's working on the blockchain space is some sort of a nerd or very like some sort of engineer. So the product that we come up today might sound reasonable or might sound usable from an engineer's point of view, but still for a complete outsider that's never heard of blockchain before, it's still not very user friendly. Like for someone, if I have to educate someone about this is your seed phase, this is how you secure yourself, those is like a very, very big barrier to entry to this market. So this is definitely another challenge they are facing. And ultimately, there was also the final challenge would be like how this set of DeFi or all this sort of amazing thing happening on the blockchain connect to the real world. Like if I want to transfer, if I simply want to fly somewhere, I can easily convert my money into the blockchain world and convert those money back. I mean, ultimately, we'll probably see everyone using their money on blockchain. But in this transitional period, how do we enable like a seamless transition between fiat currency and crypto? Those is still another very, very challenging task for us.
I mean, it just sounds like there needs to be an expansion of tools, right? Because you already have like some of these primitives, like say DAI and Compound that can interact with each other. But then you need also to interact with like some identity layer and some like Oracle layer and and like some on and off ramp layer. Is that kind of what you're saying?
Yes. And I don't think, I mean, at some stage, ultimately, we need some sort of like the on-ramp and off-ramp layer. The Oracle layer or the identity layer, I don't think they are that much important. I mean, ultimately, if we believe in a truly decentralized world, I mean, all the on-chain exchange, those decentralized exchange, they could be like pretty solid Oracle. But in this transitional period, we need this sort of like scaffolding to get us to the ultimate goal.
Yeah, I mean, like the interesting thing with oracles, and this is maybe like a little bit off topic, but like everything that goes on a blockchain kind of has to be deterministic, but the real world is not deterministic, like it's stochastic. And so I think that's kind of like the root of the problem is like, how do you take this like stochastic world and actually make it integrate with a deterministic blockchain?
Well, actually, like if everything happened on top of blockchain, you don't probably need Oracle because all the source, all the tools is already on the blockchain. I mean, ultimately, I think we'll get there. But for now, I mean, if you look at Uniswap, that's already a glimpse of light of what you see the future of a decentralized Oracle would be. Like this is like decentralized exchange built in with automatic market making. And the price fit out of Uniswap is already very, very solid and very, very sensor resistant, right?
Yeah, so like let's start going to like Laminar's protocol specifically. And I know like so you published I think in September that you had 3 protocols: margin trading, synthetic assets, and integrated money markets. You just said earlier today that you're focusing on synthetic assets, but are you still doing all 3 of those?
Yeah, of course, we're still doing all 3 of those. I would just call it synthetic asset in general because you can trade a synthetic asset in either one-to-one or in a leveraged way, and that's what we call margin protocol. I think that the easy description of what Laminar is doing is that if there's any reputable price fit for a reputable asset in the real world, we can decentralize it and make it available on the blockchain. So we're adding more variety on the blockchain world. And everyone can trade, everyone can become a liquidity provider as well. So it's like a complete trustless system. There's no entry or exit barrier for you to get into.
Can you explain like each of these 3 protocols? Because I read a little bit of the papers and they get very math and research heavy pretty fast. And so maybe Antonia, like you can help a little bit here. Can you break down like each one of these, the margin trading, synthetic assets, and money markets, and like kind of the goal of each one?
Yeah, sure. Basically, as Ruitao has introduced, synthetic means, it's sort of like mirroring what you have already seen in the traditional financial market. Firstly, one of the biggest ones is Forex. So the currency exchanges, as well as, like stock and gold and silver, that sort of stuff. Basically, you can imagine Laminar is providing like a protocol for a double-sided market. So on one side, we have banks, brokers, who do those sort of trading for the traditional financial, traders. The other side could be individual traders who are interested in taking advantage of, Forex trading or other stock and stuff, or the other like companies for say like importers, exporters who have needs for Forex tradings, and they could also come in and play. So instead of trading off-chain traditionally with another broker, someone could easily, if they own cryptocurrency, they could trade with us instead. So for our spot part, which is 1-to-1. So for example, someone, we would accept payments in US stablecoin, and we could issue, as you can see in the white paper, a stablecoin sort of euro. Because this special euro, we call it F euro token, is being minted based on the US stablecoin you deposit into the protocol. So anytime when you try to return the F euro token back to us, you could get your US stablecoin back according to the current market rate. That means that F euro token effectively acts as a euro stablecoin, because every time when you try to return the F euro token back to Laminar protocol, you could get effectively the same values of USD stablecoin back according to the current Euro USD market rate. And that's 1-to-1, a spot exchange. We also support margin trading, so there's another part of our protocol.
Sorry to interrupt you, but on the synthetic asset, like just if I understand this correctly, it would let you, like if you have a US dollar stablecoin, it would kind of let you operate, say you need to buy something from someone who only accepts euro stablecoins or like yen stablecoins. This would let you take one stablecoin, but be able to convert that to other stablecoins, just like you would in, say, the real world or the off-chain world.
Yeah, I think it's more reasonable to say that it's like you can mint stablecoin. You can make our flow stablecoin by using your own US dollar stablecoin as collateral, and you can mix euro stablecoin.
Okay.
Easier.
Yeah, that's more clear.
Actually, I mean, the way to emphasize here is that, hey, in the traditional world, those liquidity provider or those brokers, they are black box. You don't know what they are doing, and you could lose your money. But through our protocol, you can trade with confidence, and you don't actually need to know who they are because they are governed by the smart contract. They are governed by the blockchain rule. So that's like provided like fair game for everyone.
So When it comes to actually implementing these protocols, do you see them all going on a single chain, or will each protocol require its own blockchain?
Well, currently on Ethereum, it's all on one single chain, right? And it's the design of the Ethereum that every set of protocol have their set of smart contract, and they are interconnected if they all conform to some sort of interface. ERC20 being one of the most popular interface. Like if our token conform to that, then that is interoperable between all the smart contracts. However, on the Polkadot side, we think it's gonna be slightly different. On the Polkadot side, we think some of the major protocols, such as stablecoins, such as privacy coin, there might be some bridges. Those would have their own very well customized designed chain. And then on top of those very customized design chain, there might be some very, some smaller scale smart contract type of dApps that will be developed on top of those parachains. I think that's the vision that we think is gonna evolve for the Polkadot design.
Like when you design your chains to go on Polkadot has a very different security model than say a standalone blockchain or a contract on Ethereum. So how did that affect your token design? Or I guess first of all, what kind of native tokens do the Laminar protocols have?
Yeah, I think we can start to talk about the Acala token a little bit, because we already have a pretty much solid design of the Acala token. And if we are talking about how the Polkadot's model, how the parachains model is going to different from the Ethereum model, I have a lot of insight to share. So on Ethereum, you are pretty much set to bow to the underlying ledger rules that's set up by Ethereum. So whatever smart contract you come up with, all the transaction, all the consensus algorithm, all the fee models, those are from the Ethereum side still applies. So that means that if you look at MakerDAO right now, if you have DAI and if you need to transfer those DAIs, you still have to pay ETH as gas fee. And I don't think this model is going to change. Even for Ethereum 2.0, this model is going to stay. So that's what we call Ethereum is like a same sort of shard across different shard. So in terms of if you're designing this sort of protocol on Ethereum, there's some creative way to think about how the actual value of your protocol is going to reflect in terms of your value of your token. So if you look at MakerDAO's model, they pretty much have a buyback model of hey, whatever profit this protocol generates is to buy back MakerDAO token and destroy it to pretty much giving dividend to all the existing MakerDAO token holders. So those is pretty much one of the way to achieve an incentive for people to holding to tokens. There's also some other protocol have this sort of usage model, which is if you want to transact in our protocol, you need to pay for X amount of the native token for that particular protocol. But again, this is very counterintuitive as well, that you have to pay for ETH gas fee, and you have to, on top of that, you also need to pay for some protocol fee. So this is good. However, we think there could be a lot of flexibility if you're able to given more customization to do if you are developing a smart contract or developing a dApp. So that's very different if you want to build something on top of Polkadot. So Polkadot is pretty much have this shared security model. That means that you would have the full customizability of whatever smart contract or dApp or chain they were building, as long as you connect it to Polkadot and as long as the security is guaranteed by the Polkadot relay chain, then you pretty much have full customizability on how your own blockchain behave. So think about that. We can say that on our Acala blockchain, this transaction fee can be paying multiple ways. So it can be paying ACA token, which is the native token of the Acala chain. It can also be paid with AUSD, which is the stablecoin of this Acala chain. And they give us a lot of flexibility in terms of we think about how we design our native tokens. It means that the user doesn't have to actually hold our native token to actually use this network. They can just hold AUSD with the stablecoin to use this network. But ultimately, all the value can still be reflected in our token. The one unique aspect of this shared security model is how do you get a parachain slot? How do you get a shard in this relay chain? And that's the parachain auction comes into play. So that means that if you have a project and if you can convince enough supporter to bond their dot for you, they will bond their dot to support you to gain a parachain slot. How do you give back those supporters? How do you give back value to those dot holders that bond your parachain? So what we come up with is a model that issue you the native token of our parachain in a curve in a per block basis as like interest pay for your bound dot, and they'll be generated per block as reward. So that's one of the reward you can get on our parachain. You can also run an operator. You can run a parachain collector, and that's something we need to think about when we're designing on Polkadot as well. Because on Ethereum, you don't pretty much need to worry about miners. But on the Polkadot, if you want to secure, you don't actually have to secure a network, but if you want to make sure your network is live and available for use, you need to some sort of incentive to keep some collector running. They are not responsible for your security, but they will be responsible for the liveness of the network. And some of the token will be rewarded too for those collector operator as well. And we can start to think about how we can reflect the value of this network in terms of the native token. So we can. There's a lot of ideas like the transaction fee can ultimately be collected and be generated and be reflected in the native token or things like that. So I think that pretty much lie out the difference between like designing a parachain and designing a smart contract on Ethereum.
So yeah, you're going to do a dual launch. So you're going to be supporting both like Ethereum smart contracts and launching a parachain on Polkadot. What does that launch process look like for you guys?
So pretty much we're gonna we have come up with a protocol, right? So that's the rule of the game. Like how do you actually play this game? So now we have this protocol. We can design it in both Ethereum. We can also implement it on Polkadot. And let's face it, Ethereum is currently live, and there's some a community of traders available on Ethereum right now. And there's actually not very, very complicated for us to implement our protocol on Ethereum and implement it and deploy that on the Ethereum mainnet. So on Ethereum, what we'll be using is using the DAI as the base currency and just operate it as any other traditional or any other normal dApp would do, like by deploying a set of smart contract. People can already interact with our protocol the day that we go live. The plan for our Ethereum launch should be we need to deploy this set of smart contract. We need to get our security audits, and we need to inject the initial liquidity needed to bootstrap the ecosystem, to bootstrap this protocol. We already have a number of liquidity providers that they are interested in offering different set of instruments for trading on both platforms. So we think we might be very, very close to offer a set of very unique instrument on the Ethereum blockchain maybe in the next few weeks. So they would be like euro, they would be like gold, they would be like crude oil. So pretty much everything that's popular right now, we're gonna offer them as the initial set of products
so
available.
Both currencies and commodities.
Yes. Just pretty much everything that's popular and can be speculated, we're going to offer that, right? So we're targeting the current existing Ethereum users as long as they hold DAI, they have MetaMask, they can trade straight away. I mean, the initial plan for Ethereum is that we're going to launch after we go through all this launch process, we're going to inject probably like 1 million or 2 million worth of contract viewable liquidity and to bootstrap this protocol to let people to trade. On the Polkadot side, because we are able to fully customize this chain in our own requirement while maintaining security, we maybe do it in a different way than we would do on Ethereum. So on Ethereum, people are bound to the underlying gas fee that's payable in Ethereum. That's also bound to the performance of the Ethereum ledger, which means that the spread might be slightly bigger on the Ethereum chain. So on the Polkadot chain, what we design is, what we might come up with is that, hey, because it has a much higher performance, the pricing spread will be significantly better. And because we can pretty much customize the fee model, we can maybe even enable free trading as long as you have some liquidity deposit in. So those is like very, very different from what we'll be offering from Ethereum. But ultimately, I think the main difference between Ethereum and Polkadot will be down to pricing. And the reason that down to pricing is because I said earlier, the better the underlying performance ledger is going to be, the better pricing we are able to offer.
Yeah, so like what does your actual parachain launch look like? Like how do you go from designing your chain to like going into the, like what's your strategy for going into the parachain auction?
Actually, like if you go into this Polkadot parachain or parastrate economy, there's like a number of ways that we can take. You can either have a parachain slot, you can lease a parachain slot for X amount of month, if you can convince enough dot holder to support you, or you can just purchase your own set of dots and to bound those for your own parachain. There's also parathread. That's like, hey, you can pay as you go. That's pretty much like the traditional, like the conventional Ethereum way of paying gas fee. You can even collect those gas fee from the user that interacting with your dApp. And that's like the Ethereum's way. So we pretty much haven't quite decided that do we want to go with parachain or do we want to go with parastrate as Laminar. We will probably start from going from parastrate first, and then at some stage we will need to scale up. We will then attract more dot holders and more capital to secure us a parachain slot. The other requirement for us to go live on Polkadot is that we also need some sort of like base currency to trade with, right? So there's like stablecoin we need to trade with. We foresee there will be a variety of stablecoin that we're able to tap into on the Polkadot ecosystem. And so we need to wait till this sort of stablecoin is ready on the Polkadot ecosystem before we can scale up our Laminar protocol on the Laminar parachain on Polkadot.
This wraps up part 1 of a 2-part episode with Ruitao Su and Antonia Chen from Acala Network. In the next episode, we're going to talk about the Acala Network and Decentralized Sovereign Wealth Fund and how it makes their parachain sustainable. Thanks for listening to Relay Chain. We'd love to keep in touch. Follow us on Twitter at RelayChain or email podcast@parity.io. Our team at Parity includes some of the leading peer-to-peer networking developers, consensus algorithm inventors, blockchain innovators, and Rust developers. If you want to learn more about our work or want to work with us, visit our website at parity.io and sign up for our newsletter at parity.io/newsletter.